big picture thoughts. Volatility and uncertainty abound. Having just watched some of the technical corner over there with Kevin, really clear volatility is here and here to stay.
So we're going to go through the action, but the overall takeaway here is that the stocks report, the number fell, the score was lower. It was multiple months, 2 months in a row. I mean, it's showing the apprehension.
I think that's absolutely true. Falling to 48.4 below the 50 level is meaningful, and we're at the second lowest we've had over the course of the last year. And so falling 7%, not out of line with the S&P. It's always interesting to see some of the correlation between stocks and the S&P falling 7% and 6%, but certainly showing the apprehension in the markets for our Schwab clients.
What's interesting, though, is they were buying. They didn't just sell everything. I mean, no one does that, particularly because then you might miss a rally. Like today, for example, you had an opportunity to sell at a higher price if you wanted to sell. Tell us a little bit about the selling, though. I saw there was tech in there and many other sectors.
Yeah, and the tech story is a nuanced one. So net, our clients were absolutely sellers of tech. But they were buyers of some of the specific big names that you might expect. So your Palantir, your Amazon, your Nvidia. And then I think, in somewhat of what is this enigma with this market, you had Apple that sort of oscillated back and forth over the course of the month between our clients being buyers and then also being sellers. And so I think that's a bit enigmatic of what we've seen sort of holistically within the market. And then
the price objective for Nvidia was lowered from the previous $175 to $140 on Wednesday by TD Cowen, which still reiterated its buy rating for the stock. Although data indicates that Nvidia retains a great overall financial health score, the revision comes as the company's stock has dropped by around 28% year-to-date. Analyst Joshua Buchalter made the announcement and stressed the importance of Nvidia's Blackwell as a major factor affecting the company's performance in the next quarters. Blackwell will drive Nvidia's fundamentals for the April and July quarters, according to Buchalter, with the first production volumes of GB200-based NVL72 racks anticipated to increase revenue. He emphasized the potential difficulties that Nvidia's clients may encounter while implementing these intricate rack-level systems, as well as the factors they should take into account when switching from Blackwell to Blackwell Ultra. Despite the decreased price objective, Nvidia remains TD Cowen's top choice in the computing sector. The company's strong belief in Nvidia's leadership in technology and its future is demonstrated by Buchalter's remarks. Analysis shows that Nvidia has a 33.5x PE ratio and has shown remarkable revenue growth of 114% over the past 12 months. The company's present market position indicates its ongoing relevance in technology, even though it appears to be slightly undervalued according to the iFair value model. Although Nvidia stands out, the analyst offered a more comprehensive view of the computing industry in his closing remarks, indicating that investors who are prepared to assume risk during a downturn may find the sector valuable. This opinion is supported by Nvidia's solid fundamentals, which show great financial stability with a healthy current ratio of 4.44 and a perfect Piotrowski score of 9. As a metaphor for investing in a dropping market with the hope of a future recovery, the remark suggests a belief in the potential for rewards among diverse companies in the industry for those willing to catch a falling knife. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Start to take off.
So it's your largest tech holding, correct?
That is correct.
Along with, a number of these other mega caps, Microsoft and Meta, Nvidia, Amazon, Alphabet.
Yeah.
I mean, those 6 stocks are your largest holdings out of your top 10.
Yeah.
Where are these things going from here?
Look, tech has led the downturn, right? And we've seen a lot of degrossing activity in the tech space. But you have to look at where valuations were and where valuations are now today. So tech has been about a 20% premium to the S&P 500 over a very, very long period of time. At the top, and when the enthusiasm around AI really got going, we were at about a 30% premium. Right now, we're at a 7% premium. So this is the lowest premium that tech has seen in a long time. And if you step back and say, okay, look at the fundamentals around who can actually drive resilient business models in a tariff type environment, it is the tech stocks, right? And you have to think about it as they have more pricing, they have more competitive moats, so they do have a little bit more pricing power. They do have cleaner balance sheets to be able to invest counter-cyclically, and they do have higher gross margins, right? And so I do think tech is going to be much more resilient. I think the earnings estimates for broader tech are going to hang in there a little bit more than people expect. And with the valuations being at a discount, we do think it's a good opportunity on a
Thinking
relative
about,
basis.
as I was writing at this, as you say, a 7% premium, right now. If the economic picture darkens, and we rethink earnings numbers more broadly, and we decide that the overall multiple of the market needs to come much lower, then suddenly what is a 7% premium, even if it holds, is lower than it is now. That's one of the problems.
So the market is basically telling you that the earnings estimate revisions in tech are going to be worse than what they see in the rest of the market. And we just don't fundamentally believe that that's going to be the case, right? The starting point around gross margins is much higher. They have more pricing power. They have the balance sheet to be able to flex. And they have durable growth characteristics like AI. And so we do think that the earnings power is going to likely be much more resilient for tech. And so we do think that that's what's creating an opportunity for investors to start reallocating to tech.
Are they recession-proof?
They're not recession-proof. Look, certainly, like these businesses are economically cyclical, just as everything else is. But we play in a relative world, right? And I do think right now they have defensive characteristics, but they also have offensive characteristics. Think about that 1 hour where the market whipsawed up. What rallied were a lot of the AI-related names. So there is this pent-up demand to want to own tech. People are degrossing right now, and you can only degross what you own, right? And people own tech. And so we do think that there's a lot of technical forces that are at work as well that are driving some of this correction that's creating an opportunity.
The place where there's been, profound weakness, certainly lately, is the semis.
Yes.
There's also a belief that what was first in, so to speak, is first out.
Yeah.
And some of these have traded a little better lately. Now they're caught up, obviously, in some of the tariff conversation. How do you see that?
So, look, I think semis have led. Tech has led the downturn. Semis have led the downturn. I think there's been almost too much negativity now in terms of what's going on with AI and the AI infrastructure build. Right now, we're transitioning from AI models that had very linear types of answers. So you ask GPT a question, and it gives you a very linear response. We're about to go into reasoning models, right? Reasoning models, you ask it a question, it'll remember all the questions that you've asked in the past. It'll also anticipate some of the questions that you're going to be asking. That's the next level of AI that we're about to produce. And we talk about AI agents and all these things. Jensen, more recently, a couple of weeks ago, said that that kind of model is going to require 100x the amount of compute. And so there's obviously more efficiencies coming from Chinese models and things like that. But we do think we're still very much in the middle innings of this build, not in the late innings, and we think that some of the multiples have really retraced to.
In other recent news, KeyBank's Capital Markets has maintained an overweight rating on Nvidia and set a price target of $190, making the business a focus point in the semiconductor industry. Notwithstanding the industry's difficulties, such as the GB200 NVL rack yields and possible Blackwell Ultra delays, KeyBank is still optimistic about Nvidia's short-term earnings forecasts. In the meantime, Nvidia led the Magnificent Seven stocks in a pre-market climb of 2.9%, with gains coming from Amazon and Meta. As the business negotiates the intricacies of the semiconductor market, the performance of its stock is still being attentively monitored. The Trump administration's tariffs, which impact important chip-making regions like China and Taiwan, are causing turbulence in the larger semiconductor business. Due in large part to these tariffs, semiconductor stocks have declined globally, with notable drops observed in firms such as Tokyo Electron and Taiwan Semiconductor Manufacturing Co. Considering the ambiguity surrounding these taxes, Ming-Chi Kuo of TF International Securities has cautioned investors. Investors keep a close eye on how firms like Nvidia will respond to these outside forces as the scenario unfolds. The GPU Technology Conference, GTC 2025, was hosted by Nvidia in San Jose, California last month. The world's most significant artificial intelligence AI event is thought to be the yearly gathering of the AI chip leader. I saw many panel discussions regarding AI and humanoid robots, as well as CEO Jensen Huang's 2-hour keynote speech and a few of his interviews in real time. All of these meetings featured excellent information, especially Huang's keynote. It was jam-packed with exciting new product announcements and collaborations, which strengthened my conviction that Nvidia stock is a wise long-term investment. However, he made a very positive statement throughout GTC week that most investors are probably unaware of. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Vicky, I'm going to begin with you. What should investors do? We're seeing so much headline risk, so much volatility in the markets. Is there any safe haven any longer?
I mean, the safe haven is short T-bills. That's about it. As we saw, the intermediate and long end certainly sold off hard and did not provide the haven people thought. And gold has also been a little more volatile. So if you want absolute security, you're going the 1 year and under T-bills, your money markets. But for me, it's don't panic. We want to look at this market and say, over time, buying bear markets, buying this volatility has been a great way to make money in the long term. So for me, it's don't panic. Don't knee-jerk panic sell. The world is probably not ending. It does feel really terrible to be a human being. We're getting so many mixed messages. We're having, 8% intraday moves the last 2 days. So be patient. Don't get tricked into thinking it. The last 2 days, we've had these kind of false rallies, right? That, oh my gosh, it's all in. We're going to have tariffs rolled back. I got to hop on board. So be a little bit patient. We're getting jerked around. We are holding right now, and we're buying very slowly. I don't think we've seen the bottom yet, but we're starting to buy some of these things that have sold off hard that we still think have value, have protective earnings, and really strong balance sheets to overcome volatility.
Is that in the short term, everyone's going to try and protect their economies to the extent they can, because America is the world's largest economy by far. It is the world's largest consumer of these goods and services. So they're going to do what it takes. But in the medium to long term, and this process is already underway, I think is the interesting point from Trump's first term, that the world is learning to trade less with America. And I think that the other thing which is going to happen is that the massive amount of capital which flew into America, that capital too is going to find a new home. And I think that the most interesting development in the last couple of days has been that the dollar has continued to weaken. Remember what people were saying, that if you get tariffs, the dollar will strengthen. That's what was the consensus view as we began this year. Instead, the dollar has been weakening against most currencies around the world. And also the fact that bond yields in America this time are actually rising, even in the face of an equity market sell-off. I just can't remember when that's happened, that you've had a weaker dollar and higher bond yields as equities have been selling off this sharply over the last few days. So something is changing here in the global system, which is that people are saying that, we are over allocated to America. We need to diversify again. Diversification has been a bad word, for the last 10 to 15 years, because America has been really the only game in town in a way. Yes, India has done relatively okay, but among the larger markets, America has been so dominant. America's stock market came to represent nearly 70% of the global MSCI index, even though its economic weight is below 30%. So now that reversal of capital is also beginning. So I think that tells you about what's going on. So for me, the most interesting development in the last 24 to 48 hours has been the rise in the 10-year bond yield, a weaker dollar, at the same time that the American stock market has been weakening. That is an unprecedented mix that I've seen.
It was said at the GTC Financial Analyst Q&A on March 19th, not during his speech or an interview. During the Q&A session, a Wall Street analyst posed the following query: what effects does a recession have on your company to the requirement of AI? Huang's response: given that AI is the area or space with the quickest rate of growth, I believe that businesses working on the technology will direct even more investment into it in the event of a recession. Every CEO will be aware that they should move toward what is expanding. His response, in my opinion, may be seen as implying that a recession should raise demand for the company's AI-enabling products, or at the very least, not lower it. In the company's most recent quarter, which concluded in late January, those goods together generated at least 87% of its entire revenue. The products in the data center category, which generated over 87% of the company's sales in the most recent quarter, are practically all AI enabling. Though it may appear paradoxical, Huang's response makes sense when you think about it. CEOs understand that investments in AI are now so important that they are required, particularly in some industries. Because AI is developing so quickly, businesses who reduce their AI investments, even for a short period of time, risk falling behind their rivals in terms of AI skills. They might never fully recover from an existential crisis brought on by this. Assume that during the next recession or downturn, Apple made the decision to reduce its investments in AI. It might run the danger of permanently losing some of its iPhone users to rivals, specifically manufacturers of smartphones running Alphabet's Android operating system. Given that its flagship product is the iPhone, that would be a dangerous move. In the company's third quarter 2024 earnings report, Palantir CEO Alex Karp stated quite frankly that the world will be divided between AI haves and have-nots. In fact, it is likely that the AI haves, which may be nations or businesses, will win and the AI have-nots will lose. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Today. All right, KG, we're ready for the roller coaster today. You called this yesterday in terms of the price action that we saw when we initially saw gains and then ultimately finished with a fade. What was it about the price action that you were able to see that?
Well, it wasn't only just the price action. It was just the perceived risk that is out there, right? I mean, the China tariffs situation, just even having them put on was probably going to be a little bit of a risk for the equity markets as a whole, especially as some of these mega cap names like an Apple could be impacted by these tariffs. And then also the threat of retaliation from China, which we obviously are seeing that this morning as they have now re-rated their tariffs up on the United States up to 84% here. So you saw a little bit of that. And then once the market kind of opened up, when the U.S. equity session, you started seeing some of that buy volume starting to decline a little bit, getting a little bit heavy, and then that's when we started seeing the pullback here. So, the market right now obviously is experiencing a lot of volatility. You have the VIX sitting at around 56.5 right now, so it's implying around a 3.5% move in the S&P 500 for today. These are the upper downside there, so that's obviously very elevated. We have a lot of unknowns that are within the market right now, and I think now the biggest risk, Diane, is what is going to be our response to this new re-raise, and I think the market's going to probably be really focused on that. Liquidity has completely dried up when you're looking at the E-mini S&P 500 book depth. I think that's a very big concern. And then the last thing to keep on the radar for today is going to be treasury yields. Overnight, we started to see them spike a little bit. There is some speculation that maybe it's foreign sellers that are trying to kind of influence the markets a little bit. We don't really know that for sure, but we do have a 10-year treasury auction today. Around, I think, $39 billion will be auctioned. Let's see how strong or weak that auction is going to be. The indirect bidder portion of that auction is going to give you that indication of foreign demand. And if we do see a weak auction like we saw yesterday with the 3-year, I think that could probably provide a little bit more volatility here.
Yeah, I noticed and seen some commentary that the auction yesterday was weak. Let's talk a little bit about these China tariffs. I mean, China had pledged that they would fight to the end, and so they are hitting back with regard to the U.S. tariffs. So both sides increasing them with heavy effect, and we have the U.S. tariffs already in effect, China tariffs coming next. What sectors have the most exposure, or what sectors seem to be the most the weakest in this kind of a battle?
Well, I would say the technology sector is going to be the first one, and that's just because of market cap size and their exposure to revenue going from China, right, to drive growth. I mean, we kind of forget, but if you kind of look at the S&P 500, a significant portion of that, the top line revenue is actually coming from overseas, and so that's obviously going to be a big risk there. And then a lot of these companies like Apple can be in the crosshairs for a lot of these, retaliations. The agricultural market, something that goes unnoticed from a lot of traders and investors. investors, but a very key part of the United States, just in general, will also be impacted. They can put on export controls or import controls when you're looking at China, and that could also weaken demand. We already are having a battle between South America and the United States when it comes to grain prices. And so there's a lot that's actually happening in the ag space that, once again, we saw this the first time around in the Trump 1.0, if you will, and the agricultural community actually did shift and it never kind of got back to where we were. And unfortunately, they're probably going to get impacted again. Now, the U.S. government's probably going to subsidize them for any type of perceived losses out there. But even the subsidizing of their business, Diane, really does impact the smaller farmers out there. And that's kind of a little bit of a big deal. So every sector, for the most part, is going to be impacted. But I think if you're kind of looking at tech, those are going to be really in the crosshairs. If you're looking at agricultural and exports of beef, pork, soybeans, corn, those will be impacted. Corn, not so much. I do want to put this out. Corn, not so much. We don't really export a lot of corn to China, but just the broader tariffs in general can kind of slow down export demand just in general because of the uncertainty that we have on the global stage.
Well, maybe we'll be eating a lot of corn here, but sticking with some of the focus on commodities, crude oil right now sinking more than 6% below $56 a barrel for West Texas Intermediate. What's at play here? Is some of this about the tariffs? I know there's obviously supply from OPEC Plus that had initially put some pressure on crude oil, but what are the signals that you're watching to here when it comes to crude oil?
Yeah, so for crude oil, it is flashing signs of a recession. Pretty much anything below that $65 level, if you're looking at a lot of energy traders, that was a very key area for us to be able to hold here. And now we have broken it, and you're seeing it kind of move to the downside here, sitting at around $55. And it's not outside of the realm of possibility that crude could go down to around $45 here in the coming weeks and or months. But at some point in time, 2 months, 3 months of these low prices, Diane, you're going to see U.S. shale production or oil production in general start to tighten up a little bit to try to right size and try to provide price stability. And that is going to be actually the bigger concern, because if we do come to some form of an agreement at that time when we tighten up oil inventory or even just production levels, that's where you can see massive spikes in oil. So right now it's definitely signaling a recession, just like pretty much a lot of these commodities. If you look at copper, the fall from grace there as well. One thing to keep in mind and keep your eye on here, we are close to seeing a contango type of market when it comes to oil just in general. What does that mean? That means that the front month contract could actually be priced at a discount compared to future contracts. And so that is something that we have not seen in the oil market for, I would say, about 4 years or so, 4 or 5 years. And that just is going to also signify that obviously inventory levels and production levels and concerns about demand are being priced in. And then that also will reflect also the transportation cost for U.S. oil. I mean, we drill a lot, we produce a lot, we export a lot, but at the end of the day, Brent is still economically cheaper for these countries overseas, like the EU, that want to purchase. So that's also something to be mindful of.
Okay, that is great perspective and great framing on that for crude oil. I was wondering if I haven't paid attention enough to the levels in terms of years gone, if we're back at essentially pandemic levels. Let's talk a little bit about Apple. You mentioned it earlier, especially in terms of its exposure to China. It's on the receiving end of an upgrade here. Tell us some of the details.
Yeah, we are seeing Jefferies. They might be changing this, Diane, but Jefferies did upgrade.
I know.
Jefferies did upgrade Apple from underperform to a hold at the new price target of lowered their price target to $167.88. That's down from $202.33. They're basically trying to right size for the price declines that we have seen. Obviously, the iPhone shipment estimates are getting cut by a lot of analysts out there because of the risk of global recession, of a global recession, and then also just the lack of a refresh cycle that's taking place here. And they do believe that if Apple is going to be exempt from U.S. tariffs, that could actually be a little bit of a tailwind for them. So they're looking at this as more of a value play, and a lot of the uncertainty being priced into Apple for right now. And that's why they're providing at least an upgrade, right? It's not a buy, but it's at least an upgrade from that underperform rating that they had before.
Yeah. We'll see if they change direction on that. And really quickly again, because I know people like to pay attention for your levels. We broke below 5,000 yesterday on the S&P 500. Where do we go from here? Because we're essentially back and flirting with a bear market. Where do we go from here? What are you looking to as your targets?
Yeah, so for today, this is a wide range, and the downside probably will change in the next 30 minutes or so. But for the upside, looking at 52.25, 52.20 was around or 52.50 was an area of resistance yesterday. To the downside, what I'm seeing is 4,500. I'm not sure if we're going to be able to get there, but 4,500 is what I have on the radar for today. And let's see if we actually have more options of flows that kind of confirm that price level there. But wide range, I would expect some fireworks. Once again, 10-year Treasury is going to be a vol event. Yeah. Any announcement from the White House is going to be a vol event here. And so you got to stay nimble, stay tactical. And if you, once again, if you don't have to put money to work, sometimes it's just best to watch instead of putting some unnecessary risk out there.
Yeah, certainly seeing a lot of movement in terms of the 10-year right now, even ahead of with that auction happening today. All right, thanks a ton. That's Kevin Green, Senior Market.
What if Huang's claim turns out to be untrue and, in the upcoming recession or downturn, there is less demand for AI-enabling goods and services, such as those offered by Nvidia? Nvidia's balance sheet is resilient, so investors need not worry. The business is more equipped to withstand a decline in demand that results in lower sales, profitability, and cash flows than the majority of its peers and rivals. Nvidia's cash position and long-term debt are approximately equal, at $8.5 billion and $8.6 billion, respectively, as the graphic illustrates. Advanced Micro Devices, AMD, a chip maker, is likewise doing well in this area because it has more cash on hand than long-term debt. However, chip makers Broadcom and Intel are spending a lot of money to pay down their debt since they have a lot more long-term debt than cash. Since Broadcom has healthy cash flows, at least for the time being, this is a good position, while Intel is losing money. Intel's free cash flow, FCF, was negative $15.7 billion over the past year, nearly doubling its cash on hand. A machine that is FCF is Nvidia. It generated $60.9 billion in free cash flow during the previous 12 months. It could pay off its long-term debt in full or at least in part using its cash flow. That it doesn't, however, makes sense. The company has a lot of possibilities for investing in long-term growth projects because of its large cash position and enormous free cash flow.